Marcus is 28 years old, sitting in his Toyota Camry outside a Chipotle on a Tuesday afternoon, staring at his phone. He just got paid $3,200 after taxes. Direct deposit hit at 9 a.m. He's already spent $600 in his head. New AirPods, that jacket from Uniqlo he's had in his cart for 2 weeks, maybe finally upgrade his gym membership to the one with the sauna. His checking account shows $11,400. He feels rich. But here's what's actually happening. He has $0 in savings. His Roth IRA has been open for 14 months and has exactly $117 in it because he contributed once and forgot about it. And he's still contributing 4% to his 401k, even though his company stopped matching 6 months ago when they restructured. He looks financially stable, but he is one car repair away from panic. So why does this keep happening? Why do we get paid, feel like we have money, and then somehow don't? If you've ever looked at your bank account and thought, "Where did it all go?" you know exactly what I'm talking about. My name is Peter, and today I want us to discuss the 5 places to put your money the second your paycheck hits so you never have to guess again. If you've ever felt like you're saving but not really building anything, if you've ever wondered why your friends seem to have their finances together and you're just winging it, or if you've ever opened a retirement account and then had no idea what to do next, this one's for you. Make sure to hit that subscribe button and give this video a thumbs up if this helps you out, because we're about to break this down step by step. Let's start with your checking account. You know what most people do. They treat it like a savings account. Money piles up, $8,000, $12,000, just sitting there, doing nothing, earning nothing. And it feels safe. But here's the thing, that safety is costing you, not just in missed interest, in mental clarity. Because when your checking account has too much money in it, every purchase feels justified. You see the balance, you think you're fine, you're not tracking, you're not thinking, you're just spending. So here's the move. 2 months of expenses. That's it. If your rent, groceries, utilities, and subscriptions add up to $3,000 a month, you keep $6,000 in checking, maybe $6,500 if you want a cushion. Nothing more. This does 2 things. It forces you to be intentional, and it keeps your money working elsewhere. You might be thinking, what if something happens? That's what the next step is for. High-yield savings account. This is where most people get stuck. They've heard of it, they know it exists, but they're still using a savings account at their regular bank earning 0.01% because switching feels like work. Look, I get it, inertia is real, but we're talking about the difference between earning $1 on $10,000 versus earning $400. Same money, same risk, different outcome. And here's the part nobody tells you. This isn't about getting rich off interest. It's about building the thing that keeps you from going backwards, the emergency fund. 3 to 6 months of expenses, not 3 to 6 months of income, expenses. If you spend $3,000 a month, you need $9,000 to $18,000 sitting in a high-yield savings account that you don't touch unless something actually breaks. Not a vacation, not a new phone, an emergency. And the reason you put $500 a month toward this before almost anything else? Because without it, the first financial hiccup sends you into debt. And debt is expensive, way more expensive than the opportunity cost of not investing that $500 right now. This is the foundation. You don't skip the foundation. Now here's where it gets interesting. If your company offers a 401k match, this is free money, literally. You put in $100, they put in $100. Instant 100% return. Nothing else you do with money will ever beat that. But, and this is important, if your company doesn't offer a match, skip it. I know that sounds crazy. Everyone says max out your 401k, but here's the thing. A 401k without a match is just a retirement account with restrictions. You can't touch it until you're 59 and a half without penalties. The investment options are usually limited, and you're locking up money you might actually need flexibility with. So if there's no match, move on, because the next step is better. Roth IRA. This is where people fall behind, not because they don't know what a Roth IRA is, but because they think it's complicated. They think they need to be making a certain amount. They think they need a financial advisor to set it up. You don't. You open it with Fidelity, Vanguard, Schwab. Takes 10 minutes. Then you contribute $500 a month, or whatever you can afford up to the annual limit, which in 2026 is $7,000 for the year. And here's why this matters more than almost anything else. Tax-free growth. You put money in after you've already paid taxes on it, it grows, and when you take it out in retirement, no taxes. None. Compare that to a traditional 401k where you're just delaying the tax bill. You'll pay taxes on every dollar you withdraw, and you don't know what tax rates will be in 30 years. With a Roth IRA, you know. Zero. But here's the move people miss. They open the account, they contribute the money, and then they just leave it sitting there as cash. You have to invest it. Low-cost index funds, S&P 500, total market, whatever you're comfortable with. The point is, the money has to be working. From 1993 to 2023, the S&P 500 averaged around 10% annually. That's the part most people miss. The account itself doesn't do anything. The investments inside it do. Remember that checking account rule from earlier? 2 months of expenses, nothing more. This is where the rest of your money ends up. Taxable brokerage account. Same brokerages, Fidelity, Vanguard, Schwab. Same investments, low-cost index funds. The only difference, no tax advantages, but also no restrictions. You can pull money out whenever you want, no penalties, no age limits, just capital gains taxes if you've made a profit. And here's why this step exists. Because life doesn't wait until you're 59 and a half. Maybe you want to buy a house in 5 years. Maybe you want to take a year off and travel. Maybe you just want the security of knowing you've got money growing that isn't locked away. This is that money. And the reason you do this after the Roth IRA, because you've already maxed out the tax advantage space. You've already grabbed the free money. Now you're just building wealth with no limits. You repeat the same exact steps. Contribute regularly, invest in index funds, let it grow. So let's connect this back to the start. These 5 places aren't random, they're in order. Checking account keeps you liquid and intentional. High-yield savings builds your safety net. 401k match grabs free money if it exists. Roth IRA locks in tax-free growth. Taxable brokerage gives you flexibility. That's it. No crypto wallet, no individual stocks, no real estate syndication your coworker won't stop talking about. Just 5 places. In order, every paycheck. And here's what changes when you actually do this. You stop guessing. You stop second-guessing. You stop wondering if you're doing it right. Because you are. If this is clicking so far, I'm Peter. I break down personal finance in a way that actually makes sense. And look, I know this isn't sexy, it's not exciting, there's no shortcut here. But it works. And the crazy part, most people never do it. Not because they can't, because they're waiting for the perfect moment, the perfect amount, the perfect knowledge. There's no perfect moment. There's just the next paycheck. You now know exactly where it goes. You know the order, you know why. What you do with that is up to you. But if nothing else, you're not guessing anymore, and that's worth more than most people realize.